Is cash flow dead in Idaho? Man, it can certainly feel that way if you don't have a smart strategy right now. And so I've brought in my favorite non-conventional lender, Patrick Penner. I'm going to pick his brain about loan programs that are working for investors today, what the actual cash flow margins are, and how to approach properties as non-conventional borrowers, such as self-employed or business owners. Please let me know if you have any questions. You can reach out to me directly. I'll put my number in the descriptions below. Send me a text message and let's talk about how to get you into your next investment property. Thanks for being here, and let's dive in. Well, first of all, Pat, thanks for being here today. Guys, Pat's one of my favorite lenders in the business. He's been a mentor for me as I grow into the next phase of my investment career. And Pat, how long have you been lending?
Well, that's let's see, 25 years going back into 1997. I got into lending.
Damn, so you've seen some stuff.
I've seen a few things. Yeah, it's and you know, it seems to be as things progress, there's a lot of the lending that typically follows different markets, especially kind of the market that we're in compared to maybe a 97 or a 2008 market. But yeah, I've seen a few things along the way.
So when I met you, we were dealing in DSCR and wrapping loans around investment projects for not only legal liability and financial liability, but also qualifying loans that wouldn't qualify for regular folks. Is that where you started? I mean, we can get further into that, but is that where you started?
I actually started in the I started in the owner-occupied side of it, really. I mean, it was the owner-occupied side of it, doing just straight conventional loans. I did a little bit of FHA. I haven't done any VA, but I started on the conventional side, owner-occupied. And how I navigated into the investment side of it is that it became much more strategic. It was much more interesting to me to figure out how to buy a property as an investment home and owning it the right way, because there's a lot more variables, I think, when you own an investment property, you know, cash flow, depreciation, appreciation, things like that. So it was a lot more interesting for me to get into that side of it and kind of just segued into it. And I just found myself, that's why I do 95% of my business now.
So it wasn't a clear line. It was more like you, over time, you sort of integrated into the more investment focused products.
Yeah. And I think the investment products tend to be a little more creative. And that's where I think, for me, working with a lot of self-employed borrowers, it was allowing me to be more creative, because I think everybody deserves an opportunity to buy a home, whether it be an owner-occupied home, an investment property, or second home. The reality, though, is many people who are self-employed don't have that opportunity because they don't feel that they can qualify through the traditional ways.
Right. Okay. And so that brings in the second piece, which is, let's say I am a let's say I'm a business owner, and we run into this all the time. Tax returns, and there's full doc, there's partial doc. I mean, there's so many things. Are you a loan officer? Is that your title? Like, to get into these products, what do you have to be?
Yeah, no, I mean, I'm by definition, and we're all loan originators by definition, but you know, there will be some people that will call them mortgage advisors, or people that call them mortgage strategists, but by definition, at the end of the day, we're all loan originators. What we find ourselves, though, is we find ourselves playing in a space that says, okay, well, are you a loan originator working for a first-time home buyer, or are you a loan originator that actually works with creative financing to help a different segment of market, a different segment of bar qualifications, right? Versus W-2 versus maybe self-employed, if you will.
And I think of you as a broker. Like, you basically, you can take, you're not offering a specific product. You're listening to my variables and coming up with a strategy and bringing a product to the table that scratches all those itches. Is that right?
Yeah, no. So for me, I am a mortgage broker. So, you know, there's essentially a couple of different channels. You've got the big banks, you've got the credit unions, you've got the mortgage banking, and then you've got the brokering. The reason why I prefer the brokering is because I have control over the entire process. As a broker, even if I broker out, which is all of my loans, technically speaking, they could close anywhere from 20 days to maybe 35 days in time proximity. So I like being a broker because I have more control, and I don't lose that control if I'm on those other platforms.
Okay, so what do I look like if I'm your customer? Like, what kind of problems are you solving? And like, why do I need a mortgage broker?
I think the mortgage broker platform, technically speaking, has a lot more options available. Honestly, I really do. I think that, you know, and I've worked on the mortgage banking side, and I've worked on the, you know, the credit union side. I've also worked on the big bank side. The broker platform, realistically, and this is where I've gone into the investment side, is because the investment strategy side allows me to really focus on a plethora of loan products. If you're on the mortgage banking side, maybe you have those resources, but they're going to be they're going to be limited to you. And in the mortgage banking side, one thing that happens is that when you go to a broker, when you go to broker a loan, you essentially lose full control of that loan. So in some cases, that can take 45 to 60 days to close, because as a mortgage banking, it falls outside their correspondent lending. And really, big banks and credit unions really don't offer a lot of the niche self-employed borrower products. That's the reason why I love the broker world, because the broker world really opens up. I mean, you talked about it, the different types of loan programs that are out there for self-employed borrowers. I mean, I could spend a whole another hour talking about each one of them and what they do, but there are so many different ways to qualify when it comes to self-employed borrowers. There really is. And that's what makes it dynamic, because I, as a person, as a strategist, can sometimes become a little overwhelming to people in communication, as you know, because there's so much to talk about, because there's not one size fits all when it comes to lending. That's why I love the self-employed side of it.
Yeah, and I think your talent really lies in discovering the variables and then offering a product that we wouldn't have thought of without you. And I think
Right.
like that's that tricky piece is if you are self-employed. I mean, how often do you hear this? Well, I can't qualify because I didn't file my taxes yet this year, or I don't think I have, I've been writing off all my income as a self-employed person to not pay taxes on it. How can I qualify for a loan?
Well, and that's the thing. I mean, you just hit the nail on the head, right? It's two different variables, where one is, if you're a self-employed borrower, what's the number one thing you don't want to do? You don't want to pay more money to the federal government.
Right.
That's why you're self-employed.
Right.
However, when you go to buy a home, if you don't really provide all of your income, then your income's going to lack to qualify to buy whatever type of property you're looking to buy.
Right.
The benefit behind that is, just because you don't want to pay the amount of money to the federal government doesn't mean that you can't buy a home. That's why I say all borrowers are not equal, right? They should have the right to buy a home, but when it comes to loan programs, those loan programs are very different.
Right.
For self-employed borrowers specifically. So if you've got somebody that is self-employed and they don't want to provide their tax returns, there's the hybrid of bank statements. I mean, there's profit and loss loan, there's 1-year tax return program. There's a lot of them that are out there that many self-employed borrowers are just not familiar with.
Yeah, and I remember we helped a customer of mine buy 3 properties without an income stream, and you were getting into areas like asset
depletion, asset dissipation.
And it was like, it was awesome, because if you have a 401k somewhere with a bunch of money sitting in it, potentially you can stretch that out over time and call it income to increase your qualification. And it's just like, how do you go into those places without somebody who knows how to lead you there? I think that's for all the people out there watching, if you're buying properties and you're building your portfolio at 10 conventional loans, you've capped as your ability to borrow conventionally. And so having somebody who can take you into the next space is one of the reasons Pat and I hang out so much. Is I'm at 8 loans total. And because of those 8 loans, I've already moved into the non-conventional space. That's just one of the advantages is there's no limit to the number of loans you can take on if you step in a non-QM. Yep. And then potentially being able to qualify without having to qualify as a borrower is a huge advantage to people who make money and don't want to have to prove it.
Yeah. I mean, I've got a borrower right now. He's an investor, and he has, over the last 5 years, he's bought 100 homes. So how does somebody like that fit in the conventional bracket? They just can't. They can't fit in the conventional bracket. But the amazing thing is that they don't want to fit in the conventional bracket, because the conventional bracket, honestly, is kind of like, if you've written in a box, really, that's what it is. And when you start to go outside that box, when you talk about asset protection, things like that, there's a lot of benefits to not being in that box that allows you to do a lot of those things as an investor, really, that they're trying to achieve ultimately, because they want to have the freedom when owning real estate.
Right. And I think one thing you touch on there that I think is worth a quick conversation is, what I learned in my adventure here is technically you can transfer a conventional mortgage ownership into an LLC, but technically speaking, you could be triggering the due on sale clause. And so what you can't do in the conventional space is buy as an LLC. They won't let you assume the loan outside of being an individual. So there's a catch there where potentially you're exposing yourself by buying and then transferring in. So that alone leans into the non-QM space, but there's 1,000 reasons to be there, Pat. And I guess as I'm watching interest rates tick up, they're as bad as they've ever been. I know usually the interest rates are worse. I can think of interest only as a strategy we've run together. Whether or not that's better than conventional right now is worth discussing. The cost of the loan going, I mean, I could list things, but in today's environment, when working with investors, what's the product of choice?
So, naturally, I think it depends on demographically speaking, really. I mean, when you look at, okay, where are we going to buy this property and what are we going to buy it for? I think in comparison, when I'm looking at a lot of investors here in the Valley, people always say, well, is cash flow dead in this Valley, right? You and I have had the conversation. And I think, well, I think cash flow can be very difficult in a lot of demographics across the country because the cost of money is higher, right? I mean, it's just by natural attrition that is going to happen when a cash flow situation, and if you're trying to buy for cash flow and cost of money goes up, cash flow is going to be more difficult. I mean, I did an analysis the other day for somebody, and it was a $350,000 loan amount, and it was at 7.75. And then we took the same loan amount at $525,000, and at 4%, the payments essentially were the same. So you could take a 350 loan amount and you could take a 550 loan amount. 350 loan amount at 7.75 was the same at 525 at 4%. Why do I share that analysis? Well, if you take that same 350 and let's say interest rates do come down at some point, that 350, if you take advantage of a 4% rate, your cash flow position will improve by $900 a month.
Right.
So technically speaking, today, if you're looking for cash flow, that becomes a harder variable to achieve, but appreciation and maybe just holding property is more of the play right now, okay? Because the cost of money has increased so much. Now, when you also look at it, you say, well, does 350,000, if I buy a home today and that 350,000 on a 25% down payment, you're looking at a variable about $440,000 with 25% down. Versus if you go into that higher level and you wait to buy a property when the rates come down to 4% and you buy it, a loan amount of 500 and you finance 25% in that scenario, you're going to put a larger down payment around what's like 160 compared to $116,000 in savings
because of the cost of the property,
because the cost
and the
of
requirement of 25% to get
that's
it.
correct.
And that's what we run into. I mean, you have loan products that are as low as 20%. We've
Right.
even talked about smaller down payments. The reality is you're in such a big negative position on those loans.
It doesn't matter.
It doesn't make sense.
It doesn't make, but many people will tell you they have it. I mean,
Right.
you sure, could you do a 15% down? Could you do a 10?
As an investor.
Absolutely do that as an investor.
Right.
The reality though is those terms are going to be so bad.
Right.
So really a lot of investors come in and say, well, I'm trying to put the least amount of money down.
And 25 is that line in the sand where it looks like the biggest advantage with the least amount of capital.
Correct.
And what I'm finding out here is when people ask me to underwrite deals, we're looking at 35 to 40% for a neutral position against conventional rates. And then potentially you trade a little bit of principal pay down for an interest only product. And that's worth talking about too. I mean, one of the things we've done together, we were taking properties that I had bought conventionally and refinancing them into interest only loans. This is back when you can get a investment loan for 4.25%. And I was
the good old days.
I was improving the cash flow on my properties by taking the principal as cash flow rather than a principal pay down scenario. And that was an awesome strategy. It doesn't seem like maybe there's an advantage there now because of the difference in interest rate. So, and just to qualify that, instead of your principal pay down, you pay interest only, and then the money comes to you in cash flow, right?
Correct.
That's the basic principle of an interest only loan. Interest only is tax deductible. Principal pay down is not a tax deductible moment. You're then burying your equity in your house and you've got to get it back. And I've heard you say it 100 times. Nobody refinances to get the equity out from the principal pay down.
From the principal pay down. It's exactly right. It's all from appreciation.
Right. And you mentioned appreciation, but I guess I'm watching a negative trend here in Idaho, at least. July was a negative 0.1, which was the best I've seen. We've been losing about negative 0.75 on a monthly basis out here. I think nationally, actually, housing prices rose in July, and they may be doubling down on interest rates to control price creep in the housing space right now. So what are you using to buy it? Like if I'm an investor, other than, and maybe the play is, I'll buy it with 50% capital, because with 50% down payment looks like cash flow right now. And I think there are some reasons to do that. I know you hate burying capital on properties.
Yeah. I mean, I'm not a big fan of putting large down payments because, as I've mentioned to you, several times, I mean, equity has no rate of return. So the more money that I put into a home, the less it's working for me. I always say that, would I rather buy one home owned free and clear or 4 homes at a 25% loan to value, or it's 25% down payment with a 75% loan to value? And when you look at that, the ability of building wealth doesn't come from buying one home at 100% down payment, right? So that's one of the reasons. And then you brought up right now that if we see a flat or maybe a negative depreciation, well, I always ask the question, would you rather be paying principal and interest when you have an asset that's depreciating in value? Or would you rather pay interest only? Because technically speaking, you're losing on both ends. I mean, if you're in a principal and interest situation and you've got a depreciation of a property, you're technically speaking going down on two ends, right? I would prefer the interest only strategy, as you just mentioned. People don't sell homes because of, they come to me and say, well, I paid my balance down by $200,000. I'm going to sell my home now and get it all back out.
You're saying they don't say that.
They don't say that, right? They do it all through the appreciation side, and that's when typically, buyers or sellers sell their home. So when you're looking at that, they sell their home because of the fact that they have the appreciation in it.
Right.
25 years I've been doing it, it's never changed.
Right.
The question is at what point can you sell that property? What point does that appreciation start to occur, right? And that's the unknown variable because we really just don't know.
But considering 10-year cycles in the property space, that's a hard conversation to have because we saw about a 16-year cycle there, right. Maybe worse. So it's hard to say what the cycle is, but property is a long play.
That's right. And look at, if you look at the valley here and look at the valley and how much the valley is appreciated over, really since 2018. We've seen a huge amount of
double in value.
Double in value. And if you look at that, and if you look at that 5 year, and you may know this number, but I mean, if you look, what is that 5-year number on appreciation?
We were the fastest appreciating state in the entire country for the 4 years. So the equitable gain in Idaho over the last 5 years outpaces any other state. Now that may have changed in 2023 because Florida was on a run. There's some other places that in 2023, but coming from 18 to 22, nobody was beating Idaho.
Yeah, so think about that.
Yeah.
I mean, if you're at a 20% on average appreciation for 4 years running, where can you get that in any investment strategy?
We did 32% appreciation in 2021.
Yeah, that's
Ada County across. That's across Ada County, right? Eagle did 42% appreciation that year. So if you look at these minor marginal declines in value right now, they are completely offset by how we improved.
Yeah. So and it goes back, it's also interesting because I mean, in some of the things that you talk about, which is, doing the seller concessions, right? Well, if you can do a seller concession and you can actually take an interest only strategy, buy the rate down enough to where it actually makes sense, the interest only strategy becomes much more manageable and much more powerful, in my opinion, when it comes to managing a property. Because again, one of the things that happens on interest only, and not a lot of people know about it, is that when you pay down that balance on an interest-only loan, the next monthly payment goes down.
The principal balance.
The principal balance, right. So if you own an investment property and you're trying to figure out how to increase your cash flow, you don't want to increase rents, right? So if you can. You do want to. You do. Well, I should say, yeah. I should technically speaking, that's not the major play to increase your cash flow. I mean, yeah, if you're under market and rents, you want to increase your rents.
Right.
But technically speaking, you can increase your cash flow without having to do that just by principal balance reduction on the interest only strategy.
And so just to make sense of that for the people out there, you're basically saying, if I have an interest only product, I can pay the principal balance down. And because it's simple interest on the balance, potentially how much I owe gets less, which improves my cash flow.
Correct.
So I guess that does tie us back into the strategy of don't bury all your capital in one property, but potentially you could buy yourself out of a negative position. And like right now, buying cash flow is hard. To reconsider your loan at no cost by just putting money into the property and creating cash flow does sound like an opportunity, because at least here in Idaho, we are seeing rents decline.
Right.
And I don't want to call it aggressively because that sounds dramatic, but properties we're getting $2,800 a month for, we're getting $25 today. And $300 is a big swing in rent, especially because people were buying in slightly better than neutral position.
Why do you feel that is right now?
I think there's a national narrative about it, but I think also there's crippling unaffordability for people who have the financial intention of renting. Those people have credit card balances. The rates have gone up on that. Their ability to afford higher rent, I think, is the challenge right now. So, I was watching a video the other day talking about how inflation was hurting the poor, but not as bad as high interest rates were hurting the poor, because small business owners can't get loans. And then also, if you already have loan balances at variable rates, you've just taken your fixed income scenario and cut it down by percentages.
Yeah, I mean, that's kind of interesting, because then you also look at what's happened with line of credits, right?
Right.
Because you talk about fluctuation of cost of money.
Totally.
That's one of the things that's happening in home ownership, is that fluctuation in that variable rate on line of credit.
Yep.
It's eating away at the bottom line for the budget that a lot of really homeowners didn't prepare for.
Sure.
Because a lot of those line of credits have really doubled in cost of money.
Right. Yeah. And there's that moment, I'm rich because my house is worth money. How do I access the equity? Well, actually, a home equity line is a great way to do that because it's
Yes.
low cost, but the variable rate, it's doubled the cost of most of those outlying people who put money out on those to fix their house. There's no real return on that unless you sell. Maybe you bought investments with it, but if you were calculating it, the rate we had, which was 4.5 to 5%,
Yeah.
and now it's at 9 to 10. I mean, I think a lot of people got in trouble like that. And I shot a video on it because I just kept bumping into the conversation of like, that does it make sense to refi right now or take out a home equity line? And just be careful with variable rate products.
It is. And, you mentioned earlier in the very beginning of our conversations, like, you've seen a lot in 25 years. And one of the main things that I've seen consistent in 25 years, we have interest rates on first mortgages go down. Everybody takes advantage of them. And then what happens is they have all this equity position because interest rates went down. What happens to property values? They go up, right? Well, all of a sudden, first mortgage rate's super low. They have all this equity, and then they want to get what? More money out of their home to maybe buy another property. Some choose to buy a car. Some choose to go on vacation. Whatever they're using that money for, they don't want to touch their first mortgage.
Right.
So then they go after the line of credit.
2.5%.
It's at 2.5%. Who wants to go after a 4% or 5% rate on a first mortgage when the line of credit's there, right? They don't want to touch their first mortgage.
Right.
Then we see the dilemma that a lot of people are in right now, which is, okay, well, line of credit cost go double.
Right.
And then what happens as interest rates, first mortgage rates go up, what happens to property values? They come down.
Right.
And then those individuals can't manage the debt.
Right.
So now that they can't manage the debt, they're trying to figure out how to consolidate it. They can't consolidate it possibly because property values have come down. Right. Now they don't have the loan to value and the equity to do so. That has been consistent from the late 90 market to the 2008 market into this market. That's what I've always said. A line of credit is a great option, right? As long as you can manage and be disciplined to pay it off or pay it down.
Right.
That's the key.
And
that's a lot harder to do.
How often do you have hundreds of thousands of dollars staring at you?
You don't. And the other thing that I'd also mention about line of credits, and this is what's interesting, is in the 08 market, I actually saw a line of credits where literally you get the letter in the mail and they actually would freeze the line of credit. You couldn't draw anything else on it because they saw property values coming down.
Right.
And they said, well, we're not going to allow you to leverage anymore your line of credit. So therefore we're going to freeze it.
Right. Damn.
That happened in 08. We haven't seen it happen in this market because property values haven't come down.
It's possible that things are just about to get weird too, though. I mean, we're watching interest rates get higher. I was expecting them to come down by now. I mean, call me crazy, but if we were having a conversation about this 6 months ago, we'd be talking about a pivot by now this year. And instead they're doubling down. So that funny moment too, I'm thinking about it last night. I'm like, all right, interest rates go up, which makes it less likely that I'm going to sell my house, right? Less likely. And then property values come down, which makes me less interested in selling my house because I can't cash out and move forward.
Right.
And the cost of where I'm going actually has gotten considerably worse because the price correction we need to offset today's interest rates is wildly aggressive. I'm talking 35-40% in order for monthly costs to be comparable to 2.5% interest rates. So I don't imagine that could happen because what I'm seeing happen is the feds are limiting demand, but they're not limiting the demand for housing. They're limiting buyer demand, but that is really just pent up. What we're doing is we're creating another recoil scenario should interest rates correct. So if I could be so bold as to make a prediction, it's when interest rates come down, we have not solved a damn problem, including inflation. And the reality is we're just living through a tough economic time, but they're still printing billions and billions of dollars, which is why inflation is here for the first reason. And then it's not buyer demand. Buyer demand, the number of homes we have nationally, if you look at the chart between what happened in 08 and what's happening right now, we have a fraction of the available homes.
That's right.
And people need a place to live, Pat.
That's right.
You can't turn that off. People need to live somewhere. So quite possibly we peak in high inflation. It makes the numbers look better. And then they come in a correction pattern. And people are talking about second quarter next year, seeing interest rates come down.
Yeah. I mean, I believe that. I was also wondering, the reason also I asked about, the question on rents, right? I'm also wondering if the reason why rents have come down is because there's a lot more apartments being built. Right. And I'm also wondering if that's one of the major equations on what's causing rents to go down. But it will be interesting. I also believe that, it's a supply and demand issue, and it has been a supply and demand issue for a very long time.
Right.
There's not enough houses and not enough places for people to live for the amount of population that's in this country. And that's always been an issue for a lot of years.
Well, I'm
It's
seeing a
just,
lot of sellers make the decision to rent their properties too, because
Mhm.
at the end of the day, they want to manage their money through real estate,
Right.
and you can't buy with cash flow right now. So there's this moment of, well, let's just rent it out. Like
Yeah.
I want to keep my houses because there's not enough of them.
There's not enough of them. Right.
So it may be that we're seeing a larger supply in the rental space, which is putting downward pressure. But it also is, if I bought my house 7 years ago, what I need to cash flow is peanuts. And so I can
Correct.
undercut market value in order to keep a long-term tenant and or place somebody faster than you, because really the danger is in vacancy. If you're vacant, you lose.
That's right.
If you take a reduction in rent value, you can still win. You might not win as much, but winning is better than losing, you know?
A
So,
100%.
so I find a lot of people are willing to step down and rent. So it's not the same thing as the sales market, which is, there's appraisers involved more heavily, and it's a more predictable, comparable market. If I bought a house 5 years ago, I could take $1,800 a month on what I could get 25 for and be cool.
Well, and that goes back in. I mean, what you're really talking about essentially is, and it's interesting to hear you talk about it because you're going down the path of what I've seen a couple of times happen in 25 years. What I mean by that is, so if appraised value comes down, there's a couple of things that you want to be as an investor. You want to make sure that you're not putting the 50% down payment, because if you're putting the 20% down payment and you property values come down, what's going to happen? You're going to want to buy more property. Because even in this valley right now, I feel that there is a floor. I mean, you and I have talked about it, but I think that once property gets to a certain level here, it's not going any further down, because the investors know that they can actually get it to cash flow based on where rents are today. And we've seen this valley progressively grow. And I think all demographics, as they progressively go, what's going to occur is that they're all going to hit floors and ceilings. So where are we in that floor and where are we in that ceiling as a valley when it comes to cash flow and when it comes to appreciation? From the investors that I work with, I haven't seen really a lot of very many properties at all that have been bought below $375,000 right now. And those are fix and flip loans where they actually need rehab work to be done. But technically speaking, these homes are going in all around $400,000. So is that now the floor for the valley? It's hard to say, right?
Yeah, well, median
But I mean,
price.
as a realtor, you've
Yeah.
probably seen, I mean, you have homes that you've recently listed and sold that were, gone in a couple of weeks.
In the
So it's still happening.
800s, 700s,
Right.
pushing 900. Yeah.
So where's that variable where all of a sudden we start to see that pivot where all of a sudden prices go to a certain level where we don't see the demand? The demand is still there.
Totally. And I think, like, as I hear you talk about the leverage piece, there's like perfect strategy. And I like the idea that you keep your cash on the sidelines to buy in the right environment. But if the right environment is a cash flow environment, it was the right time to buy at the peak with low cost of money, because I have properties that are probably depreciating in value, but they're in a cash flow position.
Okay.
If I was to take that money today and go back to the market with leverage, I don't ever want to buy in a negative position. I feel like, rule of thumb, the game is, if it doesn't cash flow, I don't buy it. And if that's true, and that's my principle, right? There's not an environment where taking my capital to market makes sense, except when it's an obvious up curve and that you've crossed that XY axis of capital in to cash flow.
Sure.
And so, yes, to having your money on the sidelines then, but if you buy a house today with a higher percentage and then things start to turn, you have a refinance opportunity into a lower interest rate where your capital comes out and you're buying in the upswing rather than. And the worst time to buy can sometimes be the best time to buy. It's possible that the environment is to a buyer's advantage should the future look like what I just described.
Well, I also think it's interesting because I love talking about this stuff, because the reason why is the details of the information that you and I exchange can be very powerful in regards to communication, because you bring out the markets that I've been through when you start talking about the things that you're talking about, because it makes sense.
Yeah.
But the reality is if you put a 50% down payment and all of a sudden property values went down and all of a sudden you had a vacancy, what happens?
Well, at least
you
the
need
cost,
you
right?
need that money in the side fund, because if you put 20% down and the property went vacant, well, then you have a side fund that you can pay from the side fund without having to worry about the stress from a financial position. Because if you got a 50% down payment, maybe it's breaking even, but if it's vacant, it's probably not breaking even.
Well, let's say,
Right?
yeah, fair.
I mean,
it's fair.
if it's vacant, it's not breaking even.
Yep.
However, if it's vacant, at least I have the money in the side fund that I can allocate towards, is it negative cash flow position? Is it vacancy? Is it depreciation of buying more property? I always believe in real estate. While it's powerful to buy real estate, it's also very powerful to have a balanced portfolio. both in investment strategies as well as qualified and non-qualified assets. Because the verbiage that always sticks in my mind is cash is king in many ways.
Sure.
Right. And if you have it, it eliminates a lot of variables for you.
I guess it's difficult because when I had cash and inflation was at 9%, cash was trash. So there's that environment too, where yes, cash can be king, but in a deflationary environment, cash is king. And if you're a property guy, you're probably leveraged and buried in the properties, and getting that money out in a down market's almost impossible. So
Absolutely.
I hear what you're saying, but I think you touched on something that's important too, is there is no zero cost of home ownership, because taxes and insurance are always
100%.
in the puzzle. And depending on where you are, taxes can cost you thousands of dollars
That's
a
right.
month, and depends on the value of your property and the tax property rate. And one of the advantages we have here in Idaho is in Ada County, it's about an average of a 0.6 property tax,
Yeah.
and they tend to value property. They assess property value at lower than market. So, you know, potentially you're looking at $400 of fixed cost, $400 to $500 of fixed cost here, but it's fixed cost. You can't get out of it. Even if you buy the property with cash, a vacancy can hurt.
That's right. It's the cost of home ownership.
Yeah. And I think, like, again, there's perfect strategy, and knowing what perfect is great. And I almost see nobody who achieves it. And then the reality is, if you're buying an investment and then you need money to cover 2 months of vacancy and you don't have it, you shouldn't have bought the property. So overextending is something that I see that mistake happen a lot. And at the end of the day, buy real estate when you can afford it. I love that. It's like, when's the best time to buy real estate? When you can afford it.
No, it's true. But see, the other, so we're just talking about the sides of owning real estate, right? Well, what happens if all of a sudden you have the vacancy, as we've talked about? What happens if all of a sudden you want to buy more property? But what happens about the great equalizer, which is what happens if you lose your job?
Right.
Well, if you lose your job, you could have 50% down payment into 5 different homes. And the reality is you're probably going to have to sell one of those homes. And if you don't want to sell, how are you going to get any of that money back out? That's why I say having that cash on the sidelines is super important for any event.
Right.
Because you just never know when they're going to happen.
Right. And repairs.
And it's, you just don't know. And,
right.
And we always say that again, but it also is important to make sure that you have the discipline and the manageability to do it. Because see, many people who will say, you know, I've worked with these investors. I've got a lot of equity in my home. I'm going to take the equity out. I'm going to go buy another property. Well, I'm going to say, what's the side funds look like? What's your cash flow look like?
And that's a lending requirement. Reserves, as I've run into it, they expect you to have X number of reserves. And I think it's like 6 months of mortgage payment on the sideline.
Depends. Okay. But conventional is much more stricter when it comes to reserves than the non-QM space or non-qualified mortgage space.
Because you see it all the time. Hey, I've got the down payment and I can cover the closing costs, but I don't have the reserves.
Right.
And so they don't qualify for the loan.
That's exactly right.
You're right. Everybody needs cash on the side.
Yeah. And in the, you know, from a mortgage broker to a mortgage banking platform to a credit union to a big bank, the higher up you go, the more reserve requirements, because the stricter and overlays, the more overlays they have and the stricter they become in lending.
All right. I want to hold your feet to the fire here, Pat. I asked you about 20 minutes ago, what is the product of choice right now? What is it? As an investor,
I can't necessarily. So for me, if somebody came to me, what's the product of choice? Well, you know that when we have conversations, these conversations can go from, okay, give me 20 minutes of what's the product of choice. Then all of a sudden it's an hour later talking about 4 different programs.
Right.
I can't necessarily say that there's a product of choice that I'm doing, because I'm working with investors that are doing fix and flip loans. I'm working with investors that are doing DSCR long-term rental loans. I'm also doing short-term rental loans. Bank statements is another loan program that's come into play because everybody's trying to figure out how to qualify to get the best terms. So I can't specifically say that there's one program right now.
All right. What are you excited?
You know, what I'm excited about is I'm excited about getting investors and borrowers qualified to buy a home that they didn't think they could buy. That's what I get excited about.
Yeah.
It's like the client that we work with that bought 3 homes that didn't have a job, right? Or the client that actually is self-employed, owns 15 properties, and they've always gone to, you know, fix and flip or hard money loans. And now we're talking about doing a bank statement loan for them to get qualifications, because all of a sudden they now can actually refinance a lot more properties or even buy more properties because now they have bank statement income that they can qualify with that they didn't know about before.
Right. Okay.
So nobody's really talked about it.
It's not about the product. It's about the individual.
For me in lending in 25 years, I don't look at it as being specific to the loan program, because I think there's so many loan programs out there. I've got to understand you from top to bottom on how you earn your income and how you live your life to figure out what's the best loan product for you. That's the reason why these calls can take, my consultation calls, as you know, can take anywhere from 45 minutes to an hour because there's so much to uncover with that one individual. Yes, you can work with a lender and the lender says, okay, well, what type of mortgage are you looking for? And you say, well, I want a 30-year fixed. Here's your 30-year fixed for today's rates, right? But in reality, I'm actually not doing my job because there's so many other things that I need to uncover to make sure that it's the right loan program to fit you today, as well as midterm, long-term.
Totally.
Right. That's why there's more important factors that go into it.
And that's why you're a pleasure to work with, Pat. I think you truly care about getting the best product for people and you understand the strategy. I think I bump into it sometimes because I get exhausted by the conversation, and there's so much out there to know.
There is.
I think hopefully this conversation brings people a little bit closer to the variables and some of the opportunities out there.
Yeah.
And I guess I don't think we came to a conclusion whether or not cash flow is dead. I think it ties it back to the individual, the property you're purchasing, the market you're in. I think here in Idaho, it's a 35 to 40% down payment. Some people agree with that. Some people don't. I think we could argue a whole nother video on whether or not that's a good play, but it seems to be national and it seems to be directly related to climbing cost of money and stale and or stubborn rents.
Well, and another thing I also look at, right? I mean, you mentioned it, like if you're trying to get a property to cash flow, it's got to be a significant down payment. Do I want to put a significant down payment when the cost of money is higher today? Or do I want to put a lesser down payment knowing that in the future, if and when rates, because that's really the big key, right? If and when rates come down, then I can take advantage of lower rates without sinking all of my money into the property. Because if rates come down, well, maybe appreciation is starting to go back up, but we really don't know. What I'm trying to figure out is how to sink the least amount of money into a property, still trying to achieve the goals of whomever it is, whether it be owner occupied second home or investment property. It doesn't matter.
And that's before we dive into depreciation, which is the wild card and the qualification.
Absolutely.
So I get it. Well, hey, thank you so much for being here today, Pat.
Yeah,
that was a great conversation. We'll do it again soon.
I love it.